Welcome everyone for joining our webinar today, where we're going to be talking about post-election real estate tax laws and strategies. I will be your MC for the day today. I'm Brian Conlon. I'm with Meridian Pacific Properties, and I'm in charge of business development. As part of our illustrious panel today, we're going to be speaking with or getting an update from Ken Coykendall, our president. My father, Kevin Conlon, the principal and co-founder, will also be speaking, as well as Brian Wilcox, who is our guest speaker today. We're really excited to have Brian Wilcox join us. Brian is a CPA and tax partner with JGD and Associates. He rejoined JGD after several years with large accounting firms, including Ernst & Young, where he was a member of the real estate, private equity, and closely held groups. He brings more than 20 years experience serving a wide range of clients in the real estate space, including large publicly traded REITs, investment funds, to closely held real estate companies, and high net worth individuals and family groups. When not in the office, you can find Brian outdoors with his wife and 4 children, doing anything from scuba diving, surfing, fishing, or hiking. So Brian, we really appreciate you spending time with us today and really look forward to you sharing your expertise with our group of investors today.
Thanks. No, I look forward to it.
In addition to that, you have myself, Brian Conlon, and our client relationship manager, Jordan Varvel. So as far as the actual agenda and the talking points that we'll be getting to today, Kent is going to be giving another Memphis update as far as what's going on in property management, what we're seeing out there in the local market. Kevin Conlon will be speaking about the single family residential real estate market in general. And he's also going to be talking a little bit about the power of depreciation, going over a really nice case study to give our investors a sense as to the power of depreciation. Brian is going to be talking about other various tax strategies that people employ in real estate, and also give a sense as to what we can expect as we switch administrations from Trump into Biden this upcoming year. And then at the end, we're going to be doing a Q&A, time permitting. So as we're going through the webinar, if you guys have any questions that pop up, you'll notice in the bottom of your Zoom screen, there's actually a Q&A button. If you press that, you can actually type a question as we go. We may not answer the question until the very end, but please write them as they come up for you, and we'll make sure to address them at the end of time. And another piece to note, just so you guys can all be fully present and watch the show here, we're going to be making these slides downloadable afterwards, so you don't need to screenshot or worry about taking copious notes, knowing that this information will be made available to you at the end. So without further ado, let's jump into our action for today. And Kent, would you please kick us off with a Memphis update?
Absolutely. Good morning, everyone. Welcome. I typically in these presentations give an update on what's happening on the ground in Memphis and the market in general there. And I'm going to try to be very brief today and leave more time for this very interesting tax strategy conversation. Over the course of this year, it's been a crazy year, obviously. We try to keep everyone highly abreast of how the market is developing in Memphis. And it's been, we've been pleasantly surprised the whole year, and this month is no different. Rent collections remain around 99.5%. They've never dipped below that this year. That's a huge testament to the quality of product, the quality of tenant, and the quality of property management that we're able to provide. So that continues to be strong. What has been very surprising and pleasant has been the leasing activity in the market has been very strong. It continues to be strong even this month, traditionally a very slow month. Traditionally by the end of the year, lease ups slow down quite a bit, and we can end up with 5-6% vacancies at the end of the year that we then will fill rather quickly once the year turns. But this year, we're below 3%, and we're not even having to offer any move-in discounts or move-in specials to get people in at the end of the year. So that's unprecedented in the industry, unprecedented in Memphis, and really signals the strength of the market. From the appreciation standpoint, Memphis has performed pretty much the top of the market this year, with averaging between 8 and 10% appreciation. The good news is we're still considered an undervalued or on the low end of modestly valued markets. So there's still a lot of opportunity, obviously. but that's a very strong year for our current investors. And from all the research we've seen, we've had conversations with all of our banks. We've been following all of the real estate research in the market. There continues to be a housing shortage, not only in Memphis, but in many parts of the country. And we expect there to continue to be a housing shortage in Memphis for the next 5 to 6 years. And a lot of it is driven by a shortage of buildable lots, land that is entitled and serviced with utilities so you can build homes on. So all things are adding up to, we really see a long runway of opportunity in Memphis with strong demand for single family housing going forward. So I'm going to leave it brief at that. But the bottom line is we are still very, very bullish on Memphis in general and single family rental properties specifically. So Brian, back to you.
All right, thanks, Kent. Now I'll pass it right back to you, Dad, to give a Memphis overview. I'm sorry, not a Memphis overview, but really a market overview as far as what you're seeing in the single family residential space.
Okay, Brian, thanks, and good morning, everyone. Last week, I had the good fortune to be able to attend our industry's major conference. It's called the IMN conference. And my favorite presenter there is a gentleman named John Burns. He's basically, for those who don't know him, kind of the preeminent, consultant to the real estate industry. He's sort of the chief data collector on, the state of the, single family market and the build to rent market. And so what I wanted to do is share with you some of the pearls that came out of that conference. John Burns's overall thesis, in fact, the way he opened his talk was by saying that single family rentals are, as he put it, a safe, strong, and stable place to invest right now. One of the things he spoke of was a survey that he did of single family operators in 55 metros who collectively manage 175,000 single family rental properties in the United States. So it's a pretty broad data set he was drawing from. And again, remember, all of this is national information across 55 metros. It's not peculiar to Memphis. But from the data, he observed that 32% of the tenants on new leases now are coming from apartments. That's much higher than normal. And 59% of the new leases were coming from urban areas. So, we've spoken in past webinars about this urban migration into the suburbs, and this data is confirming that. Rents nationally rose well over 3% year over year after slowing quite a bit earlier in the year when the pandemic first broke out. Within Memphis, rent growth in the upcoming year is projected to remain between 3 and 4%, according to his data. 60% of the people that he surveyed that were managing these properties reported that leasing activity was either strong or very strong. And as you heard from Kent, he kind of confirmed that that's what we're also seeing in Memphis. And only 11% were reported as weak for leasing activity. 56% of the respondents said that they expect strong, continued strong leasing activity going into next year. Of great note, he said occupancy was reported as 97% nationally. He said that's the highest in over 20 years. We haven't been that high since 1995. And he said this is one of the reasons why we need to continue to build more single family homes, because during the Great Recession, there was a slowdown in building. By contrast, apartment occupancy is only around 93%. versus 97% for single family homes. So single family homes right now are kind of the hot ticket in the real estate investment market. Rents, as you would expect, are growing the fastest in the high occupancy markets. Home prices have risen at a pace of 9.6% over last year, according to this survey. Rents have also been going up, but home prices have really spiked up. I'll speak more to that in a second here. We're seeing a lot more institutional investment in the single family residential space, and it's continuing to grow rapidly. And we're seeing the large public builders of single family homes now, they're all now becoming active in the build to rent space. So all the big players like D.R. Horton and Lennar, they all have a presence. So, if we step back and say, why is this happening? Ironically, a lot of it seems to have to do with the pandemic. So, these factors mainly would include the low interest rate environment that we are now in, and this migration out of urban areas and apartments into the suburbs. And that's, that's fueled by people being required to work remotely and companies, being very comfortable with allowing them to do so. So as I step back and look at this, I see the biggest constraint to the growth of the market being the availability of buildable land. During the conference, there are a lot of sessions devoted to talking about this being the big problem for building more homes. But I also think that, as I see it, this is the thing that's going to keep the market from becoming overheated and becoming flooded with inventory. The pace of appreciation will decline somewhat, next year as we get a vaccine released and out to people, especially older people, who right now are kind of afraid to list their homes, because of the pandemic. So that that lack of supply of homes to sell is one of the main reasons why prices have gone up, because those low interest rates have stimulated demand for the housing, but there just aren't a lot of houses available. So supply and demand being what they are, we're seeing prices rise a lot. So the bottom line is that single family build to rent has been performing well nationally and specifically in Memphis. And I think it'll continue to do so for the foreseeable future. When the pandemic ends and the economy makes a full recovery, I think we will see, the growth rate slow quite a bit, but it won't crater. So that's kind of how I'm seeing that. So with that, I'd like to step next into talking about depreciation. I titled this "The Profound Tax Benefits of Depreciation," and we'll see why. But I want to open this with kind of a word problem. Okay, imagine that you have $66,500 to invest, and you've spoken to Meridian about investing in a $250,000 house, which is typical of what we sell in Memphis. And we're showing a 5.9% before tax cash on cash return. And you've validated the numbers and you understand them and know that to be an accurate pro forma. And let's say a financial planner calls you up, maybe somebody you know and trust, and he tells you, hey, I have a special bond fund that will reliably deliver on average a 7.5% annual return. It's probably a very nice junk bond fund if it had numbers like that. And you look at that and say, okay, well, which investment's the better one? A lot of people make the mistake of looking at the 5.9% and thinking, well, that's lower than 7.5%, but they're looking at it all before tax. And this is where depreciation comes in, because depreciation is what enables you to get a higher after-tax return. And very simply, depreciation is the process that's used to deduct the costs of buying and improving a rental property And it distributes this deduction across the useful life of the property, which is 27.5 years for residential property. Land is not depreciable, but structure is. So the actual physical structure is what you're depreciating because land never wears out. Depreciation is considered a non-cash expense, and it's only used to help calculate tax liability. Real estate depreciation is one of the most compelling tax benefits available to investors, and I'll explain why. All of the numbers that I show you in this presentation are based on a spreadsheet, based on some math around calculating depreciation, before tax cash flow, after tax cash flow, and so on. I'm not going to take you through this spreadsheet or the equations, but I am going to speak to some numbers that came off of this spreadsheet. And Brian Wilcox, who's on the webinar, who's our CPA, and I went over the numbers and the equations and so on to make sure that everything in this spreadsheet was accurate. So this spreadsheet enables me to take any property in any state and answer a couple questions in those blue shaded boxes, and I can draw a lot of quick conclusions about quantifying the tax effects of depreciation. Okay, now remember, we're going to be sending you copies of this or have copies available for download after this. So you don't need to take big notes, and I'm going to go kind of rapidly, but you'll be able to get copies of this later on. Okay, so let's take an example of how to calculate depreciation, and let's take a structure, a house that you're purchasing for $250,000. Now in Memphis, the structure value works out to be about 80% of the price you paid for the property. So in this example, $200,000. The 20% of land value is not depreciable. So to calculate the annual depreciation, I take the structure value of 200K divided by 27.5, and I get 7,323 per year in depreciation that I can write off against the income from this property. So let's kind of look at how we do this. And first, we start with doing a before tax cash flow and cash on cash return on investment calculation. If any of you have done business with Meridian before, you know this is a calculation we always do. This ignores depreciation because that doesn't factor in until you do the after-tax calculation. But in this example, we're taking a 250K house like the one you see pictured. We are putting 25% down. So importantly, we're leveraging, because when you leverage and get a loan on the property, the tax benefits are even more pronounced. And let's say the closing costs are $4,000, so our total investment $66,500. On the return side, let's assume that this house would rent for, say, $1,750 a month or $21,000 a year. And let's say the operating expenses, which would be taxes, insurance, property management, maintenance, vacancy, that sort of thing, totaled up to $7,140, which would be typical for this kind of house. So your NOI, or net operating income, is $13,860. So in this example, I'm assuming a 30% fixed rate loan at 3 3/8%, which is typical of what you can get now. So if I back that out of the net operating income, my before tax cash flow is $39,13. And if I divide that by how much I invested, the $66,500 on the left, I get 5.9%. Okay. Now let's look at what happens to the after-tax cash flow. Okay, so after-tax cash flow is just the before-tax flow less the tax. So we need to know what the tax is. And the tax is going to be just the taxable income from the investment times the tax rate. And in this example, we're going to use 35%. To figure out the taxable income, That's simply the net operating income, which we've already calculated, the interest expense, which I got from that nice spreadsheet that I didn't cover with you at the beginning, but I did the math. And we subtract from that the depreciation. So if you look at that set of numbers on the left side of the screen, you see that the taxable income is dropped all the way down to $316, which is not very much. So now I apply my tax rate to that. I pay $110 in tax. So to figure out my after-tax cash flow, I just take my before-tax cash flow of $39.13, back out the $110 in tax, and I get an after-tax cash flow of $38.02 in this example. If I divide that by how much I invested initially, 66.5, I get 5.7% as my after-tax cash on cash return on investment. So in this example, depreciation lowered the taxable income by $7,273, and that lowered the tax due all the way down to $110, which is almost nothing. So the before tax cash flow of 5.9% and the after tax cash flow of 5.7 are almost the same. And that's really powerful. But how powerful is it really? Okay, it's profound. And let me illustrate that two ways. First, we'll compare after tax cash flow between real estate with depreciation, which you see in the left column, calculations I've already taken you through. And now let's compare that to what would happen is if there was no depreciation and you had to pay taxes with no depreciation the same way. Think of it as if you had invested in a security that provided you ordinary dividends or interest income, so CDs, bond funds, the income you get from, real estate investment trusts or REITs. As you can see, the tax between the two is really different. You pay $110 in tax on the real estate, but you pay $26.56 in tax on the fully taxable investment. So your after-tax cash flow as a result drops way down to in this example $12.57. So your after-tax cash flow is really, really low. 1.9%. Can you back up 1 second, Brian? The key takeaways in the green box, if you don't have depreciation to write off, you're going to pay significantly higher taxes and get a much lower after-tax cash flow. So next slide. Another way to look at it, and this may be the more useful way for most people, is now we're going to look at a comparison of before tax cash flow needed to achieve the same after tax cash flow if you invested in something that was fully taxable. So again, on the left, you've seen the calculations for before tax cash flow. It turns out that you would have to earn on your $66,500 initial investment, you'd have to earn $5,850 and pay the 35% tax of $2,047 to wind up with an after-tax cash flow of $38.02, which is what you get from the real estate. If I take that $5,850 and divide it by the $66,500 initial investment, that's an 8.8% I'd have to get on a CD or a bond fund or something like that in order to match the after-tax return that I get on the real estate. And that is really significant. I mean, that literally means that if I'm in a higher tax bracket, I'd have to get about a 50% higher return in a taxable investment to match what I get in the real estate return. So that's, that's vital. So going back to the word problem I posed at the beginning, about whether you'd rather get 5.9% on some real estate or 7.5% on a bond fund, what would you do? Well, we just saw that in the case of a leveraged investment where you put 25% down, you'd have to get an 8.8% return to beat the real estate, and your financial planner buddy is only offering you a 7.5% return. So of course you would take the real estate. Now, in the case of if you paid cash for the property, you still get a benefit from the real estate, but it's not as great. The equivalent return you'd have to get on a taxable investment if you'd paid cash is 7%. So if you thought you could get 7.5% on a bond fund, and good luck with that. Arguably you would pick the bond fund in that example. Okay, now let's shift gears a little bit, because there's one other benefit of depreciation, which is really subtle, that is related to where you invest. And here's the thing. In high-cost states such as California, the depreciation tax benefits are significantly diminished compared to investing in low-cost states. So let me give you an example of this. Okay, so here in California, where many of us live, when you buy a house and it's going to be a rental house, typically the range of structure value in California is between 55 and 65% of the price you paid for the property. Whereas in Memphis, it's 80%. Okay, so let's hypothetically say that there was such a thing as a 250K house in California, and we applied a 60% structure value to it and depreciated it. We'd have a 150K structure value in California instead of 200K to depreciate. And the amount of depreciation is 54.55 a year instead of 72.73. And this is investing the same amount in buying an asset that was worth the same. You get more to deduct in Tennessee and Mississippi. So the tax that you're going to wind up paying, because the depreciation is lower, is higher in California. You'd be paying $747 in tax compared to paying only $110 in tax. The before tax cash flow is the same because depreciation hasn't been looked at yet, but the after tax cash flow is only 4.8% in California compared to 5.7 in this example. So the takeaway is that, if you're investing in a place like Memphis, the after-tax return is nearly 20% higher than it is in California, simply due to the larger amount of depreciation you can write off because of the higher structure value, in and of itself, with all other things being equal. And this is very, very compelling.
We got about 2 minutes left in this section.
So other things to note about depreciation: the higher the marginal tax bracket, the more valuable it becomes. And the more you leverage, the more valuable it becomes. Depreciation allows reduction of your state tax bill in addition to federal. I just talked about federal here, but the math is similar for state. Depreciation is a means of deferring taxes, not avoiding them. So know that if you do an ordinary sale, say 10 years from now, all the depreciation you wrote off accumulated, you're going to pay 25% depreciation recapture tax. But you can avoid that if you do a 1031 exchange, which Brian Wilcox will talk about shortly. Always be certain that your CPA knows what the correct structure value percentage is for the state and submarket in which your property is located. This mistake gets made in California all the time if you're investing in Tennessee and they forget that the structure value is 80% and not 60%. And cost segregation, which Brian Wilcox will speak to, is a way to greatly accelerate your first year depreciation write-off. It's really fascinating. So, and in conclusion, I would want to leave you with these points. Depreciation is truly one of the greatest tax benefits available to investors, especially for higher tax brackets. And based on the election which just occurred, it's inevitable that the tax rates are going to go up. So depreciation is going to become more important than it's ever been. Ordinary taxable investments right now require between a 40 and 50% greater before tax cash on cash return to match what you can get in Memphis. As we just discussed, structure value is much higher in Tennessee and Mississippi compared to a place like California, and you get an after-tax return there as a result that's 20% greater right out of the chute. You can avoid depreciation recapture tax using 1031 exchanges until death. And cost segregation is a way you can greatly accelerate depreciation to maximize the tax write-off. But there are some special rules associated with being able to take that write-off, and you need to talk to your CPA about that. And certainly Brian, I know, is an expert in this area. So with that, I will turn it back over.
That's right. Hey, thank you so much, Dad. Yeah, without further ado, I really want to welcome again Brian Wilcox, who will be momentarily going over some of the additional tax strategies of real estate and also talk a little bit about the post-election landscape for real estate investing. So let me go ahead and get the slide here going for you, Brian. And well, apparently, there we go. And we are off and running. Over to
There
you.
we go. All right. Thank you, Brian, and good morning. And thank you, Kevin, for the nice compliment there. So as Kevin mentioned, depreciation is by far the most powerful tool, a reason why you would want to invest in real estate. It basically shelters income, and it's one of those investments that can't really effectively be replicated with other types of investments. So overall, Kevin mentioned much of this, but why do people invest in real estate? And one thing to note, I've been doing this for about 20 years or so, and all my high net worth clients, at some point started investing in real estate, and that seems to be their largest assets. It's a big part of investing strategies for the high net worth clients. So overall, why would you invest? Cash flow, Kevin already mentioned that. His calculations, when Kevin and I went over his calculations, those calculations were fairly conservative in the sense that it doesn't factor in principal, because that's a cash on cash return. At the same time, as time passes, the leverage that you took on is reducing, so you're building equity. That's a powerful tool. So in looking at that analysis, it actually is the actual economic gain is actually more. So of course you have the appreciation of the assets. He mentioned that even though you get to deduct it, it's taxed. The depreciation shelters ordinary income, which is taxed at 37% or higher. You get to recapture that income if you decide to sell the asset at 25%. So it's a benefit even after you decide to sell it. Also, one of the things that a lot of people don't know is that when real estate, when you depreciate real estate, you get all the benefits of those deductions. When you pass away and you pass it on to the next generation, the IRS allows you to restart the depreciation. They allow you to take the depreciation all the way back up, not only to what you originally paid for it, but take it up to the fair market value at that date. And so your heirs will receive an asset that they can even depreciate even more. And going back to Kevin's 80-20 rule, you know, it's based on, they'll get a lot more depreciation. So it's a very efficient asset that you get to pass on to the next generation. Another thing is, as time goes on, as it appreciates, you can leverage, you can put more, you can refinance it and leverage that asset and take the cash out. That process is generally it's not a taxable event. So you can take appreciation out of a real estate property and redeploy it in other investments, or you have access to that capital. So at the end of the day, real estate, you know, I've been around the real estate arena for quite some time. The people that buy and invest in it over the period of time, they make good money, and I see it time and time again. So if you want to go to the next slide, you can do that. So the you know, a couple of strategies in the real estate space to keep in mind. One is the cost segregation study. Kevin mentioned it a little bit earlier, and the cost segregation study is a very powerful tool. What it does is, Kevin used a 27.5-year rate of depreciation, and obviously that's a small number. So 1/27th, you know, of the asset of the building is it's a slow amount. Well, if for some reason you have more income, you could do what's called a cost segregation study. And what a cost segregation study is that you hire a professional, typically engineers. There's a lot of companies out there that do this, and they have experience knowing what this real estate, what is in the building, how it was constructed. And we all know that there's a lot of different parts to a building. There's cabinets, there's carpet, there's fixtures, many of which, if you look closely at, the IRS has a different tax life that you can accelerate the depreciation. So instead of using 27.5 years, you could use 15 years, you could use 7 years, you could use 5 years. So it really accelerates the write-off. So if, especially if you're in a situation where you're getting taxable income that's being generated off the real estate properties, you can look into these cost segregation studies. And one of the powerful things here is that it's a cumulative effect. So even if you don't do it right off the get-go, you can do it 5 years in the future, and then it will allow you to go back and write off all that depreciation and dump it into the current year. So in situations where you have a lot of income from real estate, it may be a very wise planning tool. So they've been around for quite some time. The IRS, there's a lot of court cases on it. So it's important to hire those professionals. They know the inside and out how to do these studies. The other very powerful tool available to investing in real estate is the 1031 exchange. And the 1031 exchange is, especially for people in California where you have a very highly appreciated asset that you may not be making more than 3 or 4% on a year. You could take that asset, sell it here in California, and exchange it. Let's pick a state, maybe Tennessee, where you can get a much higher return and even possibly diversify into several different assets. If you have one single family home in California, that could be $750. That could be 3 homes. And correct me if I'm wrong, Kevin, but you can get 3 homes in Tennessee and spread the rent out, so it helps with vacancies and things like that. So what a 1031 exchange basically allows you to do is it allows you to, one of the key concepts is you can never take hold of that cash. You have to hire a professional accommodator that will allow you to sell the assets. They hold the money for you while you find the replacement properties, and you can exchange into the properties. Now, a couple of things to keep in mind. I already mentioned that you can't take any possession of the cash. And these are all general rules. Do remember that. But there's some things you need to consider. Number one, never take possession of the cash. Number two is you have to identify properties within a pretty short period of time. So 45 days, you have to identify that property. Then also you have to close on the deal within 6 months. So the whole transaction needs to be done. A couple things to keep in mind, you want to exchange up in fair market value in order to avoid gain, exchange up into fair market value, and then make sure that you wind up with more debt than you had before. Those are just some rules of thumb to help you avoid any gain. So go ahead and go. Yeah, exactly. So of course, with every investment, there's a few things you want to keep in mind. The IRS over the years has put in place a lot of limitations. One limitation is that, let's say you go do that cost segregation, you create a $50,000 loss. If you don't have more than $50,000 in income to offset it with, they're going to most likely limit you. There's all kinds of limits, mainly the passive activity loss rule. So if you're not actively involved in it, they'll limit it. If you're not a real estate professional, you'll limit it. So the one key thing is that you have to be aware that there are loss limitations. You can use passive losses against other passive income. So if you have lots of other passive income, certainly you can utilize those losses. The other thing to keep in mind is that if you decide to leave California, if you have always been a California resident and you decide to invest in other states, every state has its own tax system. There's just a handful of states that don't have a personal income tax. So it's important that you understand what happens in those states. For example, Tennessee doesn't have a personal income tax, but they do have this weird rule that they tax single member LLCs as corporations. Many attorneys, lenders, they'll require you to buy these assets sometimes in a single member LLC. So it's really important to consider that you could wind up being treated as a C corporation, which Tennessee has a strange franchise and excise tax that you have to pay as a C corporation. You'll want to talk to your attorney and find out if there is a special rule that will allow you to elect out of that treatment as a single member LLC. So we would defer to your attorney to make sure that that's a good liability, that you're protected sufficiently with insurance and things like that. So the other thing, Mississippi, they have, for example, Mississippi has a personal income tax, and if you buy real estate in Mississippi, you generally be required to file in that state. There are de minimis rules, but they're not very high. So most likely you'll wind up having to file a tax return in the state related to the income only to that state. One thing to remember too is that California won't double tax you. So if you wind up paying tax in Mississippi, for example, California will give you a credit against California tax for any tax paid. You won't be lowered down to Mississippi tax rates of 3 or 5%. If you're in the 13.3 tax rate in California, you're going to pay 13.3 tax in total, no matter what, regardless if 3% of that goes to Mississippi, the rest goes to California. It doesn't allow you to have income taxed at a lower rate. You're going to basically pay the same amount of tax in California. So all you guys probably want to know what do we need to do for post-election? We all wish we could. We wish that. I think the consensus is that the election. It would have been nice that the election had been over when the election occurred. Most of you guys know about the 2 Senate seats in Georgia. With a lot of the tax planning that we're looking at, everything is on hold until we really know what happens in Georgia. If the Republicans are able to hold at least one of those seats, our consensus is that the taxes will remain about the same for the next 2 years until the next election. the broader thing, even that's a short-term view. The long-term view is that the taxes are going to go up, which makes investing in real estate, a good place to be, especially because it's tax efficient. The government has to pay for stimulus, it has to pay for the debt, has to pay for entitlements, and the collections are just not enough to pay for those. So in our profession, we all recognize that taxes are going to have to go up to cover that. So long-term planning, taxes are going to be high. Near-term planning, we'll have some clarity in about 3 weeks. But anyhow, so let's say that as I mentioned, if the Republicans do win at least one of the seats in Georgia, it's going to remain status quo for the most part for the next couple years. If the Democratic Party wins both seats, it'll be a tie in the Senate. It'll be 50-50 split. The vice president will break that tie, and ultimately the Democratic Party will have control. Not all is bad news if that happens. One of the things, if you go back to when the last time the Democratic Party had control of Congress and the taxation, it takes a long time for things to get passed. There's a lot of negotiations that takes place. These laws are hundreds and hundreds of pages long. Plus, there's a lot of moderate Democratic members that have constituents that they have to answer to. So you factor all of that in, and I think that in our profession, we're really thinking that we're going to still have time to make moves, but you just don't know. So there is one thing between now and the end of the year that we're talking to our high net worth clients, and that's the state exemption. Right now, it's $11 million per person. It's a lot. It's a lot. It covers most per person. So if you're a married couple, it goes up to over 22 million, and that covers most 99% of states out there. But what has been proposed by President-elect Biden is to lower that exemption down to like 3.5 million in total, or possibly per couple. We don't really know. But 3.5 million, that becomes a much more realistic number for a lot of our clients. So one of the things that we are doing is seeing where people are at in their estate planning and whether or not it's time to start transferring assets to the next generation. So that's one thing that you might want to consider, because what would happen is they can't come back to 2020 and change the tax law, but if for some reason they are able to change it, this is one of the things that could easily be changed and take effect as of January 1st, 2021. So just something to keep in mind. Next slide. All right, so we don't, like I said in the beginning, we don't know what, we can't read the future. I personally am a believer that the process, it's not going to be dramatic, but even if it goes fully Democratic, I think that there's a lot of people, we're in a pandemic, last thing you need to do is raise taxes. It's more or less trying to keep the businesses, able to function, keep money in people's pockets and stuff like that. But just to go over some of Biden's proposals that have been out there, some of them are more rumor status. So like the 1031 exchange is the very last one. That some people are saying that Biden doesn't believe in 1031 exchanges. It would, I didn't find anything specifically written about that. It's more all conjecture or people opinions. But starting off at the top there, the reduction of the estate tax exclusion, going from 11 to 3.5 million. That's a big one for a lot of people. Raising the highest marginal rate from 37 to 39.6. Biden is proposing to eliminate the capital gains tax on high income earners. So if you earn over a certain amount, they're going to tax it as at ordinary tax rates, which has always been, for the last few decades, a couple decades, 3 decades, capital gains have always had a favorable rate. Another thing that they've talked about is getting rid of that step up that I mentioned earlier, that allows for that step up to fair market value. It allows a very tax efficient transfer to the heirs. So they've talked about getting rid of that. One of the things that Biden does mention a lot in all of his proposals is he kind of draws a line that if you make over 400,000, he wants to raise your taxes. If you make less than 400,000, you're not going to pay more taxes. So that's that one item. Corporate tax rates, he wants to raise corporate tax rates from 21%, which is what Trump lowered it down to 28%. Many of you might be saying, well, I'm not a C Corp. Why? I would never use a C Corp. But one of the things to keep in mind there is the lowering of that the corporate tax rate has really helped the stock market and corporate earnings and it's helped your 401ks and your pension plans, has made businesses and publicly traded companies more profitable. If the interest rate goes, the tax rate goes up on those publicly traded companies, it's going to put pressure on the valuations of those companies. Increasing Social Security withholding for wages above 400,000. Right now, it's limited to like in the 130,000 range. Also, he wants to take away the benefit of itemized deductions for the $400,000 plus group. And then lastly, I already mentioned it, was the 1031 exchange. That there's a question of whether or not they want to do away with the 1031 exchanges and the ability to do that, which is a really big part of the real estate arena. So at this point, I think we open it up to questions.
Yeah, I agree. Thank you, Brian. We have this webinar going for another 8 minutes, so we'd love to give everyone a few moments here to type in any questions they may have while we got Brian on the line here. Certainly, if questions come up post-mortem, so to speak, you can always reach out to any one of us at the office, or we'll even be sending Brian's contact information out directly, so you can always reach out to him if you want to get some CPA-related support around any of your tax situations that you may have going on. All right. So Kent, did you actually want to chime in and ask this question?
I just want to, Brian, if you could clarify the $400,000 limit that you're talking about, is that for single taxpayer or is that for joint returns?
My understanding is that it would be a family type situation. It's a household.
Okay, got it. Second question, you went down to that whole list. What's a realistic expectation of worst case? How many of those? I mean, that's a very long list. Not all of those would ever get approved. What do you think is a realistic scenario of what might get approved?
Well, I think that there's, the lowering of the estate tax, that's a realistic one because very few people that would impact. I think that's realistic. Increasing the tax rate, I think that's possible because that's the 39.6 rate is what we had before. And so I think that's a high likelihood. The capital gains rate, that would be a very, I mentioned that's been around for many years, far longer than I've been in practice. So that one would be tough to change. Mechanically, I'm going through each one of these, but I'll try to do it fast here. But mechanically, the step up of basis on inherited assets creates a mathematical problem with being able to pay estate tax and then passing it on to the next generation. So there is a actual mathematical problem with eliminating the step up of basis. So that I don't even know how they would pull that one off. The corporate rate, I think that could happen. Once again, it doesn't impact individuals. Most people won't really be able to tangibly see that impact them. So I could see that happen. The itemized deduct, I see a lot of these being able to be passed. The 1031 exchange, I don't think would pass. They got rid of part of the 1031 exchange as part of the Trump tax cuts, but the 1031 exchange is so in our society and so part of the real estate market. I would see that as being a very unusual step. So.
Great, thank you, Brian. Jordan, did we get another question?
Yes, it looks like Nate Brown has a question. He says, can you clarify the step-up basis?
Sure. So what happens is, let's say you own, I'll keep it in the real estate market. Let's say you bought a house in 1971 in La Jolla. So I see escrow statements for what those, sometimes I see them in our files here. You know, you paid $100,000 for a house that overlooks La Jolla Cove. You know, today it's worth $8 million. So what happens is when you pass away, if it's worth $8 million and that's your only asset, you wouldn't pay any estate tax. Okay, so that $8 million, what you paid for at 100,000. Would then go, the basis would go to 8 million. Your heirs the very next day could sell that asset and pay no tax on it. So effectively, the step up would allow you to take an asset that you paid $100,000 for and transfer it both estate tax free and income tax free and get cash to your next your heirs. So let me know if that answered that question.
Yeah, I mean, Brian, can you even speak to the depreciation difference?
Well, I was just saying that was your home. So let's say that you bought it for 100,000 and you depreciate it to 0. You still get the step up to fair market value. So it cleanses, if you will.
Nice.
And Brian, how does that real estate step up interact with an increase in estate taxes in general? Does that exist outside of that increase in estate taxes in general?
So let's just say that, if I understand your question. So let's say that they, you know, the current exclusion is 11 million. So in the example we just talked about, there'd be no tax paid. Let's say it dropped down to the 3.5 million. So that $8 million home, you would have to pay estate tax on everything above the 3.5. And if my math is correct, that would be, you'd pay estate tax on 4.5 million, which the estate tax rate is currently 40%. So it's going to be, you know, roughly between $1.5 and $2 million of estate tax that you would have to pay, that your heirs would have to pay. And of course, you'd probably have to sell the asset to pay it and stuff like that.
Brian, different question, different topic. Suppose I have a single member LLC that owns rental property in Tennessee, and I'm subject to franchise and excise tax in Tennessee. And let's say I pay $1,000 in franchise and excise tax. On my California tax return, do I get a credit for that $1,000 against my California taxes or not?
Well, yeah, that's not necessarily an easy question. There's going to be lots of limitations, and right now, generally, most of our tax paying clients are not getting, because of the exemption and the limitation of $10,000 of ability to deduct taxes. You know, it does prevent the ability to deduct the taxes. So it's a little bit different than Mississippi, where it's an income tax. In Mississippi, you have an income tax where you get a credit off your California. The other tax would be a little bit different.
Okay.
Analysis.
All right.
All right, Brian, another one from our audience. Was rental depreciation 80% in Tennessee versus 20% in California? Is that correct?
No, it's typically the structure value of California property ranges between 55 and 65%. So in the example I used, the midpoint 60%. So on average, I would say that California real estate's usually depreciated with structure value at 60%, whereas in the Memphis metro area, it's 80%.
Another question, well, for you, Brian. You recently sold a condo in which California referenced that about 30% of the value of my unit was land. I'm sorry, was structure, and about 70% of it was land. Is there a rule of thumb that needs to be used when doing those depreciation calculations, or is 55 to 65% something anyone can use regardless of what the actual land and structure value is?
Really, ultimately, it would really come down to an appraiser, a qualified professional to be able to do the specific allocation. But did you mention a condo? Or
yes,
so
correct.
in a condo situation, often there's a smaller land component. Like for example, if like in downtown San Diego, if you bought real estate in downtown San Diego, there'd be less land component because the land is shared by 400 units. So in a condo situation, same thing there is that you have less land allocated to the actual building. So we often would see land being a smaller component. And I think in your example, you said land was a higher component.
Land was about 70%. In other words, I was just wondering if I use it as an investment, even though I have this document from an appraiser that says 70% of the value is in the land, from a tax standpoint, can I treat the land as being the 35 to 45% as we discussed earlier in this presentation?
I would in practice we would see the latter there. You could see a more of an allocation to the building, but really it would come down to a battle of professionals if it ever got challenged. If the IRS would have their professional appraisers and people, engineers and people to be able to design that, and the only way to have more confidence would be to hire a professional appraiser and to allocate that.
Gotcha. All right, doesn't look like we have any more questions, and I realize we're 2 minutes past our time here. So I really just want to extend again a special thank you to Brian and really all of our panelists for sharing what you have today. It's very much appreciated. To all of our listeners, like I said, we will be making both the video and the presentation and Brian's contact information available in the event that you would like to rewatch or dive more deeply into the numbers that we presented today. You can certainly reach out to me if you have any questions about what we discussed, inventory or otherwise. And we appreciate you all being with us very much. With that being said, I wish you all a great rest of your day and certainly a happy holiday season. And we'll talk to you guys very soon.
All right. Thanks, Brian.